Welcome to Retirement Mentorship. I am your host, Freeman Lindy, Certified Financial Planner. You may have noticed, if you've been listening a long time, that we've been rebroadcasting some of our old episodes. Part of this is because I'm still too busy to make new content, although I'm hoping to get back to that. I've been really focusing on making sure that we get our weekly email out on time to everyone. So if you're not subscribed to that, you can do so at retiremembership.com. Otherwise, we will be getting back to new content, but part of the other reason for rebroadcasting old episodes is that most of them are still timely even today. They are, most of them, right, evergreen content that is good no matter when you listen to them. So last week we played the trouble with target date funds because target date funds are still an issue. Today we're going to rebroadcast time in the market because time in the market versus timing in the market is still just as relevant today as when I first recorded it 2 or 3 years ago. So we're going to rebroadcast that episode again today, and then next week, hopefully, we'll get on to new episodes with new content. If you're new to the podcast, feel free to go back, right? This is not like a time, on-time podcast where you only want to listen to the latest ones. You can always go back and listen to all of our episodes in the past. Most of them should still be relevant today. And even if you have listened to those way back, right, when we rebroadcast, it should still be a good reminder. There's that saying that we more often need to be reminded than we need to be taught. And so that's one of my jobs for you, is to continue to reinforce your belief in financial planning, in making the right behavioral moves. And one of the ways to do that is constant just reminding of those truths. So I hope you enjoy this rebroadcast of Time in the Market, and we'll see you next week with some new content. Cheers. Before we look at correctly time the market, we must first wonder why time. Why should we time the markets at all? In typical fashion, of course, we will look at why not to time the market, and then why you might try. Second, we're going to look at how you must be right twice in order to successfully time the market. You need to be right when you get out, and also when you get back into the market. Most of us learn better from stories and examples, so we're then going to look at the tale of 3 brothers, a story of how 3 different brothers invested over time and how they each tried different time methods and the outcomes of those methods. And then lastly, we'll look at correctly time in the market. How can we do it, and how can we do it successfully? That's coming up on the Retirement Mentorship Podcast. Time in the markets. People love to invest when the market's going up. And when it continues to go up, people get excited and continue to pour money into it. But then at some point, it begins to stall. And people begin to say, hey, what goes up must come back down. And they begin to wonder if they should be getting out. We're in such a time as this right now. The S&P 500 hit all-time highs at the beginning of September and has gone down since then. People are wondering, should they be getting out of the market? Is this the time to time it? Should we exit? So let's study this concept of time in the market. Is correctly timing the market even possible? First, why time? Why would we even try to time the market? In order to help understand why we might try to time the market, let's first look at why we would not try to time the market. There are 3 reasons not to try and time the market. Number 1, to reduce volatility. Some people think it's a good idea to try to get out of the market when things are choppy. We don't want to be in volatile markets, so let's get out. We talked about this already in episode 13, what about the risk, and episode 21, risk tolerance questionnaires are stupid, about how the goal of investing is not to avoid volatility. Volatility is your friend. Volatility is what allows us to gain the superior returns of equity investing. Without the volatility, there is no growth. And so our goal cannot be to eliminate or even reduce volatility. That's not the point. The point of investing is to make money, not to reduce volatility. Making potentially dangerous moves in your investing plan just to avoid something that you don't even need to avoid is, stupid. You don't try to time the market simply to reduce or avoid volatility. Reason number 2 you wouldn't try to time the market is to wait out a crisis. There are a lot of people who think they should get out of the market because they see a looming crisis ahead. The dollar is about to explode. War is going to break out somewhere. There's probably going to be a recession. There might be another variant of COVID, whatever the crisis is at the time. They think it might be better to wait out any crisis by getting out of the market now, and then we can get back in once the crisis is avoided. This is a pointless exercise. One, because you can be completely wrong about the said crisis happening in the first place, or about the crisis's effect on the markets. And two, what is the point of that? If, for example, you are invested in the S&P 500 and it is at 4,400, and you think a crisis is coming, and so you get out of the market, and let's say a crisis does come, and you were dead on, and there's a crash, and then the market eventually comes back, and the crisis resolves itself, as they always do, and then you get back in, and the S&P 500 has come back to 4,400. Yeah, you avoided the volatility maybe, or you avoided the crash, but if your only goal is to wait out a crisis, and then you get back in right where it was before, you haven't done anything. And so at best, you're going to end out in the exact same place you were if you hadn't done that. And at worst, which is more likely, you're going to be wrong about something in there, about the crisis in general, or about the outcome of it, or whatever else may happen. Or you may be wrong about when you get back in, and waiting out the crisis turns out to be one of the worst mistakes that you could have made. There is no point in getting out of a market just to wait until a crisis is over. That leads to reason not to time the market. Number 3, to cut our losses. I'm going to go ahead and assume here that we're talking about a properly diversified portfolio inside of an investing plan that you've created that fits your goals and will help get you there. We're not, for the purpose of this discussion, talking about investing in single stocks or in speculative, quote-unquote, investments. Sometimes with those speculative endeavors, you should cut your losses and let them go. But if we're talking about a properly diversified portfolio of the best equities in the world, then you never, I repeat, you never get out of the market to cut your losses. That is horseman number 4, the fourth horseman, panic. Selling your equities when they're down. This is the only way to turn a temporary decline into a permanent loss, is to sell your equities when they're down. We do not do that. We do not do that. If you are holding equities and the market goes down and you think it's going to go down further, you do not sell at that point to try to cut your losses in hopes that you don't lose more. It's just out of bounds. There's no way. That's not trying to time the market. That's just being stupid. That's making the worst mistake you can possibly make. Now, we're not at that point right now, right? The market's still fairly high. As of recording this, it's not, of course, at an all-time high, but it can't always be at an all-time high, but it is still up. And so we're not at that point right now, but many people do wait for that point before they try to get out, before they try to time the market. They like to be in it when it's going up, and then as soon as it starts going down, and after it's gone down enough, that's when they decide that, hey, maybe timing the market's the way to go. And that would be wrong. You never cut your losses in a properly diversified portfolio. You never abandon the plan when it's down. That is the worst thing you can do. So those are the reasons not to time the market. Why would you try to time the market? Well, the only reason any smart investor would try to time the market is to sell high and buy low. Right? That's the only reason. Like we already said, it doesn't do you any good to sell out when it's at a high and then wait for some crash to be over and then to buy in again at the same price. You're going to be exactly where you were if you had just stayed in, minus the dividends that you probably missed out on that were paid out over that time. And so that doesn't do you any good. And of course, it does you no good to sell out low after it's already gone down in hopes that it would go down further and probably having to buy when it's higher, right? You don't sell low and buy high. That's a good way to go broke. And so the only reason to try to time the market is to try to sell high and buy low, right? We think the market's at an all-time high. We think a crash is coming. And so our objective is to time the market, to time the cycles, and to sell now when we're at a relatively high point in the market and hopes that the market goes down, and then buy low at that point. And so we can ride it back up the other side. So that'd be the only reason to actually try to time the market, the only smart reason. Now, I'm not saying it's smart to try to do that. I'm saying that would be the only reason you might try. So why wouldn't we do that? Why wouldn't we try to do that? It seems smart, right? Buy low, sell high. Let's do it. So that brings up one of the big problems with trying to time the market is that you have to be right twice. Right? It's the right twice problem. You have to be right when you get out, when you sell out and get out of the market, and you have to be right when you get back in. So when we're talking about being right the first time, right? We're assuming that you're already in the market and that the first move we're going to make is to get out of the market. So you must be right when you are getting out, right? You have to be at a point where the market is high and you believe that it's about to go down. The market is high and you believe it's about to go down, so you get out of the market. You must be right about this decision though, because what if you're wrong? What if you think it's about to go down, so you're selling at what you think is a high point, and then what if it keeps going up and keeps going up and keeps going up, right? At what point do you get back in? Right, so let's say you're in the S&P 500 and it's at 4,400 and you get out, right? Because you think it's about to go back down. It peaked at 45, it's down to 44. You're like, well, it's probably going to keep going for this, that, or whatever reason, so you get out. And then it doesn't keep going down. It goes back up and goes to 4,500 and 4,600 and 4,700, 5,000. It just keeps going up. At what point then do you get back in? Because you've been out this whole time, right? You got out of the market because you thought you were going to be right, and now you're in cash or short-term securities, and you're waiting for it to go down so that you can buy low. And what if it never does? What if you're wrong? At some point, you're going to need to get back in. And let's say you're dead wrong and it keeps going up and it's up at 4,800 and you lost out on all that gain from 4,400 to 4,800 and you finally like, well, I guess I was wrong. There doesn't seem to be, the economic disaster was averted and it didn't affect the markets and I was wrong, whatever. So I lost out on some gains. And then you get back in at 4,800. And then out of the blue, something hits that no one expected. And then the market falls. Right, so not only did you miss out on the gains from 4,400 to 4,800 because you were out of the market and you were wrong when you got out, you're also wrong when you got back in because now as soon as you got back in, that's when it actually fell. And so you're hit doubly with bad outcomes. That's very difficult to recover from. So you have to be right when you get out of the market, right? And there's obviously no way to know what's going to happen in the future. Hence the quote at the beginning. Most economists don't know what's going to happen in the future. Most of them are wrong. So you can find professionals, economists, all these smart people that will tell you all these bad things are going to happen, and most of them don't occur in the way that people think, and it's just you're more likely to be wrong about these things. And so you have to be right when you get out. And you might be saying, well, hey, I have to be right at some point, right? So maybe I wasn't dead right. Maybe I didn't get out right at the top, but at some point it's got to happen, right? The market's overvalued or it's above its trend line returns. And, at some point the market's got to fall, right? So if I get out now, like maybe I'm not right immediately, but eventually it has to fall, right? Because it's overvalued now and has to come back down to realistic values. And the only way for that to happen is for the market to crash. So I'll be right eventually. And that's just not true. Even if your premise is true, right? That the market is overvalued or that the current returns are above long-term trend lines, and so eventually it has to revert back to the mean, right? And it's going to have to crash. Like even assuming that it is overvalued, a crash isn't the only way that can correct. You can have a season of flat returns. Not really positive nor negative, or you could have a long season of very low growth, right? So if it averages 10% and over the last X years it's been doing 15%, like so it's way above, so it's got to come way back down to average back out, maybe, or maybe it just grows for the next decade at 2% and eventually comes back to the long-term average. It doesn't have to crash in order for that to happen. It might, but it doesn't have to. And so even if your premise is true, your conclusion may be wrong. And if you're going to try to time the market, you must be right. So let's say you are, though. We're at 4,400 now, you sell, you get out, and then the market does collapse. Something happens with China or whatever, it doesn't matter. And the market collapses. Then you have to be right twice, right? You have to be right when you get back in. And for all this to have worked out, right, you have to get in when it's lower. We need to sell high and buy low. If you're not going to do that, just leave it alone. You don't have to worry about it. And so you must get back in when it's lower. So when is that exactly? When it's 15% down? When it's 20% down, it's officially a bear market. 25, 30% down. At what point do you get back in? So let's say that we got to have a plan. If we're going to do this, we have to have a plan. We can't just wing it because we'll probably miss the bottom. The chances of hitting it dead center in the bottom, not very likely. So let's make a plan. So you say, okay, I'm going to get out. And then when it drops, as soon as it hits 20% down, then I'm going to get back in the market. Even if it keeps going down, maybe I don't time it perfectly, but hey, I still bought when it's 20% off. And so I'm going to be much better off than if I just stuck it out. So you do that. So you aim for 20%, market's going down, S&P 500 is going down, the world's blowing up, whatever's happening, and it keeps going down. You're like, yep, I was right, feeling really good about it. Keeps going down, 10% down, 15% down, 16, 17, 18, 19% down. You're right up to your trigger point, and then it stops going down and it rebounds. And it goes back up 5% or 10%. Now what? What do we do then, right? So maybe it's not back up to where it was, and maybe it's going to keep going down. Maybe it's just a temporary blip up, and it'll continue down to 20% down or lower, and then we can do it, but maybe not. And what if it just keeps going up and then it recovers completely and keeps going up and keeps going up? And when do you get back in? And you run into the same problem of getting out correctly. That if you're wrong, when do you get back in? And that's also very difficult to do correctly. So let's look at this with some real world events that have happened in the past, and with the tale of three brothers. So imagine with me that there were three brothers that were going to invest over 40 years. Because again, it doesn't really matter how well we do over a year or two, especially if we're saving for retirement or saving for these long-term events. We could beat the market this year, that year, but if in the long run we underperform the market or do terrible, it won't matter. So let's look at these three brothers, and they're going to invest over the last 40 years. All right, so 40 years ending in June 2021 is the data we're using. And there's three brothers, Ty, Joe, and Eddie. And they decide that they are going to invest $200 a month every month over 40 years. And then see what happens. So they started 40 years ago, and they just finished up in June here. And Ty is known as Buy High Ty. He always puts his money in the market at the worst possible times. And so he decided, he's pretty hesitant about the market. He doesn't like the volatility, and he's got to really be a big believer before he invests. And so what he was doing is he would put $200 a month into into CDs or bank accounts, whatever, that was generated in 1%. And he really had to watch the market go up for a long time before he was finally convinced that investing in it was a good idea. And so he would just put money into the bank, and then after a long period of time, he would finally invest. And Ty had the worst timing of all time. He got it wrong every single time. And so over the last 40 years, there have been 5 market events, 5 crashes that we want to look at, right? And so the first one was Black Monday, and that was back in 1987. And the thing that's unique about Black Monday, of course, is that it was the largest single-day decline in history. It went down 22% in one day on Black Monday. And the whole bear market that ensued because of that, the whole thing lasted 101 days. So for 101 days, the market was basically going down, and it ended 33% down. And then the next one, there was about a 20% drop in 1990. That was 87 days. There was then, of course, the dot-com crash, in which case the S&P 500 went down 49%. And what's unique about this one, of course, is that it was the longest bear market of all time. The market was going down for 768 days. 768 days for over 2 years, with volatility in there, but it mostly just went down, then finally bottomed out and came back. So that's the longest bear market. And then, of course, there was a financial crisis in there as well, which was the deepest bear market we've ever had since the Great Depression, right? 57% down from the start to the bottom of it. And then, of course, the COVID crash of 2020, which was the fastest decline of 30% or more. 34% in 33 days, right? In the Black Monday event, it took 101 days to go down 33%, and in COVID, it happened in just 33 days. So he went through all these crashes, all three of the brothers did, and Buy High Tai had the worst timing of all. He always invested the month before, and before the event happened, when the market was at its peak. And so $200 into a bank account every single month, and then bought into the S&P 500 at the worst possible times, only to see his investments drop right afterwards. The next brother, Joe, he was called Buy Low Joe, and he kind of had a similar strategy where he thought, you know what, I'm just going to buy low. You're supposed to buy low, sell high, so I'm only going to buy it when it's low. I'm going to time these cycles. And he also put $200 a month into bank accounts, earning 1%. And then instead of buying, after the market had been going up for a long time, he always bought at the bottom of the crashes. So he bought at the bottom of Black Monday and the 1990 bear market, .com, financial crisis, COVID, all those, he bought at the best possible time, bought low. And then the last brother, Eddie, he was known as Steady Eddie. He didn't do any of this timing. He just put his $200 straight into the S&P 500 every single time, reinvested all the dividends, and just didn't care. Didn't watch the markets, didn't try to do any timing, didn't care about the cycles. Just Steady Eddie kept putting his $200 a month away into the market. So what was the results of these three brothers after 40 years of investing? Buy High Tai, investing at the tops of every market. Buy Low Joe, investing at the bottoms of each market. And Steady Eddie, investing consistently regardless of what the market was doing. Well, at the end of 40 years, they had each invested $96,000, right? $200 a month for 40 years, $96,000. And at the end of 40 years, Buy High Tai had $780,000. So, not that bad. Considering you have the worst timing of all time, the unluckiest person in the world, getting $780,000 out of 96,000 invested, that's pretty good, considering. Buy Low Joe, of course, did better. He did buy at the bottom of every single crash. And so he had $1.13 million. Much better returns than Tai because he always managed to buy low and didn't ever do anything else. And what about Steady Eddie, the person that just continued to put it in regardless of what the market cycle was doing? Well, at the end of 40 years, he had $1.57 million. So again, 1.1 for Buy Low Joe and 1.5 for Steady Eddie. So Steady Eddie, not timing the market at all, just continuously putting his money into the S&P 500, regardless of what was happening, didn't pay attention to the cycles or the headlines or the crises, just continued steadily, beat out everyone else, even the impossibly great timing of Buy Low Joe. The moral of the story is, of course, that even if you somehow could perfectly time the market, which of course no one can do, and you could only buy at the bottom of crashes, you would still underperform people who steadily invest regardless of what the market is doing and just stay invested. That brings us to our last point, correctly timing the market. If professional money managers can't successfully time the market, why do you think you can? Right? If professional money managers can't successfully time the market, why do you think you can? We've covered this before, that the vast majority, 93% of professional money managers underperform their relative indexes over 15 years. They can't keep up. They can't do any better than just letting the market ride, than just investing and doing nothing. These are people with Harvard degrees and letters behind their names and all of that, with 6 monitors and all the information in the world, and they cannot successfully time the market. Why do you think you can? Economists are constantly forecasting doom and gloom and bad times to come, and they're constantly wrong. By the time the financial crisis, the recession of the 2008 was over, by the time it was finally declared the recession was over, the market had already recovered. So not only did they fail to predict it in the first place, they failed to predict the end of it, and people who are waiting for economic issues to be resolved before they get in the market or get back in or whatever kind of timing they're trying to do were wildly unsuccessful. Because it turns out that it's actually not about timing the market. It's about time in the market. It's about owning equities and continuing to own them, to invest and to stay invested,
to ignore headlines and crises, and to stick with the plan. No one can consistently, successfully time the market. No one. You can maybe do it once, maybe twice, but not consistently. Meanwhile, those who don't try to time the market, who just have a plan and stick to it, far outperform their average investor. We covered it again in episode 1, investor versus investment returns, that the average investor does half as well as the market in general. And it's because of things like this, attempts to time the market and fall into the other behavioral mistakes. You cannot successfully time the market, but you can spend time in the market. You can invest and stay invested. You can have a plan. You can continuously act on the plan, and you can stop reacting to the markets or economists or the news. And that is how you successfully spend time in the market. If you need help creating a plan and sticking to it, you can listen to episode 33, which will give you some tips on that. If you have questions on this episode or on anything else, you can email us at questions@retirementorship.com or call 1-866-6-MENTOR, and we'd be happy to chat with you. That's all for today. We'll see you on Friday with a few action items from today's lesson. Have a great week.
If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership, and it has a host of benefits, all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time. We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, or you can click in the link in the description and it'll go right there. We can't wait to see you in the community. Cheers.